In the previous module, we looked at how to evaluate projects using various techniques, such as NPV, payback, IRR, and so forth. In those discussions, we were given the cash flows. By now, we all know that projected cash flows are the key element in evaluating an investment or a project. So in this module, we talk more about what are those cash flows and what should be included in their calculation. In our last module, we examined the principal methods of evaluating alternative investment opportunities. We saw that we could use the net present value and the internal rate of return criterion to evaluate riskless projects when there are no constraints. In this module, we examine what are the relevant cash flows associated with projects. We define incremental cash flows, and we look at some special cases of project analysis, in particular the case where we have projects with unequal lives. We close the module with a discussion on capital rationing, constraints, and how this affect the firm's decision about the number of types of projects undertaken. Everywhere in the world, not just Australia, the tax law requires businesses to depreciate assets like plant and equipment over several years and charge this depreciation as an expense in the income statement. This has the effect of reducing the income subject to tax. Thus, firms have to pay less tax and ultimately have more profit to do other stuff. Knowing this, past governments and the policymakers in Australia have changed the depreciation rules to stimulate investment. As a result of these changes, a small business could claim 50% bonus tax deduction on certain items, like computers and vehicles, while large businesses were offered tax incentive of 30% or 10% deductions on certain investments. Further incentives were introduced to improve cash flow of small businesses by allowing them to write off fully assets bought for a value of $6,500 or less. This has implication on the timing of cash flows and ultimately on the NPV. Better to have $6,500 now rather than 4 years down the track, which when discounted has a lower value. Remember the time value of money. Relevant cash flows, also known as incremental cash flows, are the changes in the firm's future cash flows that arise because of the decision to accept the project. These are the cash flows to be included in our decision-making process. A cash flow item that exists irrespective of whether or not a project is undertaken is not relevant. The term standalone principle means that the project is viewed as a mini-firm that has its own revenues, costs, cash flows, resources, etc. This approach suggests that the project is evaluated entirely on its own merits and demerits, and is evaluated in isolation from any other project that the firm might undertake. These are the issues that need to be considered when evaluating the cash flows of a project. First is the distinction between cash flow and accounting profit. These two are not equal, and sometimes there is a huge difference between them. Capital budgeting uses cash flows. Also, financing costs are ignored. Included or adjustments must be made for all these items to properly estimate a project cash flows: tax, non-cash expenses, fixed asset expenditure, working capital, terminal value, and so forth. And we also ignored the irrelevant or non-incremental cash flows like sunk costs. We will now discuss each point individually. As mentioned earlier, financial statements are prepared using the accrual-based method of accounting. When an asset is purchased, the cost is not treated as an expense and is deducted from revenue. This asset is depreciated and the book value in the balance sheet is reduced. It is this depreciation that is charged in the income statement. In the income statement, the revenue is recognized when it is earned, not when cash is received, which is being matched with the expenses used to generate that revenue. And that's why we have accounts receivable and payable. So even if we have sales, these are on credit. There is no cash in hand yet. Out of all these accounts, we must somehow find the actual cash received and paid to get a true reflection of cash flow for that period. Therefore, a project cash flows is calculated as operating cash flows less changes in net working capital, less net capital spending. Financing costs, which include the interest payments to creditors and dividends to shareholders, should be excluded from cash flow calculations. These costs are captured by the required rate of return or the cost of capital used to discount those cash flow to arrive at an NPV. By including this in the cash flow calculation, we are double counting financing costs. Tax payments are cash outflows, so are included when they occur, not when they accrue. Thus, the relevant cash flows to be estimated for the project are the after-tax incremental cash flows. Taxes will change as the firm's taxable income changes. Consequently, we have to consider cash flows on an after-tax basis. Finance relies substantially on accounting-based information. However, accounting figures encompass a range of non-cash expenses, including depreciation, amortization, and depletion. As we mentioned earlier, accountants charge depreciation to spread a fixed asset's cost over time to match the flow of economic benefits. Amortization is used on intangible assets like goodwill and patents. Depletion is related to depreciation, but mostly used in resource companies where the cost of natural resources is moved from a company's balance sheet to its income statement. Although the evaluation of projects and investments is focused only on cash flows when they occur, these non-cash expenses are important because they indirectly affect cash flow through their impact on taxes. Let's look at depreciation to see how we account for that. First, depreciation is calculated using straight-line method or prime cost, where the amount of depreciation calculated based on the original cost of asset, thus is the same value every year. Or we can calculate depreciation using the reducing balance method or the diminishing value method, where the depreciation amount is calculated on the reduced book value of the asset. Thus, each year the depreciation amount is becoming smaller and smaller. To calculate the true cash flow, we either calculate after-tax income and add depreciation back, or calculate after-tax income ignoring depreciation and add back the depreciation tax saving. Certain countries like UK and US allow one depreciation method for tax purposes and another for reporting purposes. In this course, we consider only the method used for tax purposes, since depreciation affects cash flows only through tax. This is an example of depreciation values using both methods. We have an asset that has been purchased for $14,000 and has a 5-year life. Using the straight line method, we observe the same value for depreciation each year, and the book value at the end is 0. Therefore, the implied rate of depreciation is 20%. With the reducing balance method, the depreciation charged is a function of the book value of the asset every year. This method allows larger depreciation charged and thus a larger tax deduction at the beginning of the asset's life. Note also with this method, at the end of the 5 years, the book value is not zero. This is an example on how to account for depreciation when estimating the cash flow. Assume a company purchases a fixed asset today for $30,000. It plans to depreciate it over 3 years using the straight line method. The company will produce 10,000 units a year at a cost of $1 per unit and selling price of $3 per unit. Company pays taxes at a 30% marginal rate. Note, because we have prime cost method, the depreciation is equal every year. 30,000 divided by 3 years, 10,000 depreciation charged per year. Remember, we said we can find the cash flow 2 ways. First, we calculate net income after tax and then add back depreciation as shown in the first table. Why do we add back depreciation? Well, we don't physically pay anyone 10,000 hard cash in hand for depreciation. It's an accounting entry. It's there purely for calculating the tax payable. That's why we add it back to the value of net income to show that in fact we have more cash. The second method calculates again the net income ignoring the depreciation amount. Separately, we calculate the tax saving what we get from depreciation and add this amount back to the value of net income. We should get the same result for the cash flow figure. The most obvious cash expenditure on a project is the purchase of a fixed asset, a piece of equipment or machinery. However, what is not so obvious is that sometimes when the project is finished, we can sell these fixed assets and get some money back. This money that we receive at the end is called residual value, scrap value or salvage value, and is considered an inflow of funds in the last year of the project. Furthermore, if the salvage value differs from the book value of the asset at the time of sale, there is a tax effect. So if the salvage value is greater than the book value, a gain is made on disposal. This gain is subject to tax, which means we've charged excess depreciation in previous periods. On the other hand, if the salvage value is less than the book value, we have a loss on disposal, and this is considered a tax deduction, which means we haven't charged enough depreciation in previous periods. For example, a company purchases equipment for a project that costs 10 million and 0.5 million to install. At the end of the project, the equipment was fully depreciated and was sold for 1 million. The tax rate is 40%. Because the asset has been fully depreciated, the book value is 0. And because the salvage value is 1 million, we have a gain on disposal on which we must pay tax. This 0.6 million should be included in the projected cash calculation, as it is considered an inflow in the last year of the project. Many projects also require additions to working capital in the form of purchase of inventory. These typically represent a cash outflow at the beginning of the project and an inflow or recovery at the end of the project. Unless a business runs 100% on a cash basis, there will always be cash to be received or to be paid in the form of accounts receivable and accounts payable. To calculate the true cash in hand, we must then adjust for changes in the net working capital, which is current assets and current minus current liabilities. We adjust only the net change in working capital each year, where an increase in net working capital is a cash outflow and a decrease in net working capital is considered a cash inflow. Think of inventory. If we purchase inventory, we increase the working capital due to increase in current assets. which means we paid for it or about to pay, and that is why it's considered an outflow. The increase in net working capital is considered an outflow. This is reasonable. For example, if sales increase, we normally hold more raw and output inventory and have larger accounts payable and invest in accounts receivable to support these sales. The main components of net working capital are cash and short-term marketable securities, accounts receivable and payable, and inventory, raw and output. This is an example of working capital adjustment. Imagine we operate a calendar selling booth in a shopping center from the 1st of November to 31st of January. We order 15,000 worth of calendars on credit with delivery by 1st of November. Must pay suppliers $5,000 a month beginning the 1st of December. And we expect to sell on a cash basis only 30% of inventory in November, 60% of inventory in December, and 10% in January. We must always have to have $500 cash on hand. This is the balance sheet at the beginning of each month. From the information given, we can calculate the net working capital every period and adjust the cash flow accordingly. Remember, increase in net working capital is a cash outflow, and the decrease in net working capital is considered a cash inflow. So, for example, let's take November. We spend on putting $500 in the register. We order 15,000 worth of inventory, which are fully on credit, so accounts payable and inventory accounts increase. The current asset minus current liabilities is 500, positive 500. Cash in the register plus inventories less accounts payable, this is the monthly change in the accounts in the net working capital, which overall is a positive $500, which is an outflow. Again, let's take December. We sell 30% of inventory in November, 4,500, which leaves us 10,500 in December. We pay 5,000 in accounts payable, which leaves us $10,000. So current assets minus current liability is $1,000. Overall, cash in register plus inventory less accounts payable, overall we have $500 an outflow. Again, if it's positive, it's considered an outflow. And so forth and so forth. We do the same calculations for January and February. Let's take the last month, in February. In February, we empty the 500 from the register. We sell our remaining 10% of inventory in January and receive cash 1,500 for it, leaving us with zero balance in the inventory account. And lastly, we pay the last $5,000 of accounts payable. The difference, current assets minus current liabilities, is zero. There's no change. However, from the monthly change, we have cash in register plus inventory minus less accounts payable, zero, and the net change from previous months is plus $3,000, an outflow again. The projects we have evaluated thus far have finite or limited lives, where we were able to forecast cash flows using realistic assumptions for a number of years. However, in practice, many projects, think mines or electricity generators or large factories, have very long horizons, like 20 or 30 years, and some may have even an indefinite life. For example, like a forestry plantation, with a program of harvesting and replanting, and an agricultural or fishing enterprise where stocks are managed sustainably, or even another firm. We know equity is long-lived. Instead of forecasting over these future periods, which although easy with Excel, carries only the pretense of realism, we only forecast for the immediate period and then use a terminal value for the remaining life of the project. This is in line with the process of discounting inherent in the NPV, IRR, and profitability index techniques, where the inflows far in the future have little impact on the value today. For example, an annual cash inflow of 10 million is expected for this particular project, which grows at 3% per year for 100 years, and using a discount rate of 10% is valued at 148 million. But 48% of this value arises from the cash flows in years 1 to 10, 73% from years 1 to 20, and 96% from years 1 to 50. By using a terminal value, we assume that cash flow beyond this point will grow at a constant rate. This is similar to case 3 of share valuation, where we had to calculate the price at some time in the future when the growth rate became constant. Because of this terminal value is larger than all the other cash flows, it's supposed to reflect all those future discounted cash flows. Usually this is performed for projects with more than 5 to 10 years of cash flows. There are 3 ways in which we can calculate the terminal value. The first is the same in share valuation, where we assume the cash flows after a certain point grow at a constant rate. The second is multiply the final cash flow estimate by a market multiple, like the average PE ratio or price to cash flow or price to sale ratio of companies in the same industry. Or the third, use the investment book value or liquidation value as the terminal value. For example, Invigorate Limited wants to acquire Tribor Pty Ltd. The acquisition will generate the following cash flows. In year 1, 0.5 billion, in year 2, 1 billion, and so forth. Beyond year 6, the growth rate is constant and 5%. And the analysts believe the cash flow will continue to grow at that rate constant. What is the terminal value of this project? Using the first approach, we calculate cash flows initially in year 6 as 3.41 billion, then use the dividend discount model to find the terminal value for year 5, which is 68.2 million. We discount this with the other cash flows to arrive at the current value of the project. Remember that the last 2 cash flows occur in the same year, in year 5. In the second approach, the price to cash flow ratio for the companies in the same industry as Tribor is 20. Therefore, multiply this by the last forecasted cash flow, we get the terminal value of 65 billion. A note of warning: although the price to cash flow ratio now is 20, in 5 years' time, even if Tribor does indeed have a cash flow of 3.25 billion, the average market multiple might not be the same. In our example, we are not given any info regarding the book value or the liquidation value of the project. This third approach is most used when the investment involves physical plant and equipment, where the depreciated book value is assumed to be zero or the liquidation value can be zero, positive or negative. In all the examples used so far, the investments or the projects have been independent. We assessed a project based on the standalone principle, where its cash flows were independent of other projects or the firm as a whole. However, most of the time, projects are not independent. They are dependent on other projects or mutually exclusive, and we've seen the problems that arise in applying IRR to mutually exclusive projects. Generally, accepting an investment can create spillover effects or side costs and benefits for a firm's existing investments. These negative side effects include use of resources that the business already owns, such as opportunity cost, and lost revenues for other projects that the firm might have. The positive side effects that may not be captured in the traditional capital budgeting analysis include project synergies, where cash flow benefits may accrue to other projects, and options embedded in projects, including the option to delay, expand, or abandon a project. When analyzing the cash flows for a new project, these costs and benefits should be incorporated. A common negative side effect in firms with multiple products is cannibalization or erosion, where the introduction of a new product will reduce the sales of existing similar products. And these are some examples. Apple would have considered that the introduction of the iPad mini would have had an impact on sales of the normal iPad. Likewise, introduction of a new airline flight for the same route may come at the expense of full cabins on the original route. In terms of capital budgeting, when evaluating a project, we would want to include the lost revenue from other product lines into our cash flow calculation. A positive spillover effect is when the firm establishes a new distribution system that can be used for existing or future projects. These potential future cash flows must be included in the project analysis. And these are some examples of benefits or synergies that the most noticeable example is a typical Disney animated movie. The benefit is not just the ticket sales, but also the revenue from all kinds of related activities like the sale of merchandise, increased attendance at Disney themed parks, stage shows, television series, computer and console games, etc., etc. This can continue for some decades with re-releases of widescreen, digitized, director and 3D version of Disney favorites, and so on. So these examples, these future cash flows that a project can earn must be included in the original initial project analysis. Opportunity costs are existing benefits that must be given up if project proceeds. When a project uses a resource that has been already paid for or owned by a firm, it needs to be included in the evaluation of a new project. The resource has to be priced on its next best alternative use, which may be selling it, in which the case the opportunity cost is the expected proceeds from the sale, net of any capital gains taxes, or renting or leasing it out, in which case the opportunity cost is the expected present value of the after-tax rental or lease revenue, or use it elsewhere in the business, in which case the opportunity cost is the cost of replacing it. For example, if a company has empty office space that can be used for a new project, the lost income from renting the offices should be included in the evaluation of the new project. Or the use of empty land to build a new plant. By using an asset that the firm already owns, the company forgoes the income from selling the land. At the beginning of the module, we said that we should only include incremental cash flow in project evaluation. Non-incremental cash flows are those that have already occurred, like sunk costs, or are generated by the firm irrespective whether the project is taken, like HR personnel costs. Example of sunk cost is test marketing for a potential product before its production. If the company does go ahead with the new product, these costs should not be included in the evaluation of future cash flows to be derived from this new product. Or the R&D costs for a new drug should not be added when evaluating the value of future income to be derived from the sale of the drug. These are costs that happened in the past and are not recoverable. Thus, they are irrelevant to the decision whether to accept or reject a project.